Hello traders, welcome to the LFB and our global video charting review for February the 18th, 2011. My name's Marco Haig from the LFB Trade Desk. Content and data is courtesy of the automated trading program run by the LFB Trade Desk. We do have to point out that Forex trading does involve substantial risk of loss and is not suitable for everybody. Please read and accept the disclaimers posted to the LFB website before taking information from the videos. Looking at a chart of the Dow Jones here, and these are momentum indicator candles. When they're blue, there's a bullish undertone. When they're white, there's a bearish undertone, and then we've got a simple moving average trend line. Just looking at that quickly shows you blue candles, bullish momentum in an upwards trend. That's a setup that you would look to buy the dips. As long as the candles stay blue, pull back below the simple moving average line. As long as the simple moving average line continues pointing higher, you'll be buying the dips. Global equity trade continues to hold the higher ground with a continued pattern of trade that has gaps at the open of most Asian sessions, which continue to create one or two 1 hour bursts of energy that contain most of the price action on any given session. Earnings season has allowed equity traders to hold long positions in an environment that has attention drawn to finding fair value in the very near term, rather than looking for mid-term valuations on stocks. This is something that will be challenged when earnings season soundbite headlines stop in March. The Japanese Nikkei took out the 10,800 upside price point and is consolidating recent moves that have been very sporadic in nature, and any kind of signal will now come as a consequence of a test on the Japanese Nikkei at 10,750. European equity markets looked very bullish over the course of 2011 with no test of support failing to hold. The German DAX has gone through 4 sessions of sideways consolidation. Looks very much like this German DAX trade and the Dow Jones are getting aligned in their movement. With regard to the 4-day consolidation, we then have 1-day breakout, then another 4 days of consolidation. Traders are seeing an attempt to form a short signal on the DAX, albeit against a very strong long trend, and that'll only be confirmed with a break of 73.50 on the German DAX, which will target 100 points lower. It's going to be unwise for new positions to be opened going long at any of these extended levels. Looking at S&P 500 trade, which is the most liquid of the global market equity trade, you can see the S&P looks just a little bit more bullish than the Dow Jones that we're just looking at. S&P traders continued to hold Wall Street equities higher, with most price action happening between 10 and 11 o'clock East Coast time on any given day. The sheer dominance of Federal Reserve open market operations cannot be underestimated in the moves higher from stocks. That's helped the market in its ability to hold the long side of equities without much reason to move to cash in each region's trade. A sell signal will be confirmed on the S&P 500 with a break below 1320, currently trading up at the 1335 area. For those not already positioned on the long side of stocks, now is not the time to be looking to buy into an extended market that's very reliant on the Fed backstopping risk. These are very sporadic and very volatile periods of trade. In general, the last week of February will likely be instrumental in gauging the global equity market sentiment and ability to hold the higher ground. Existing long positions are being held as low volume futures market moves reveal that market makers and liquidity providers are keeping things in a very tight range. Taking a look at global commodities and a look at the gold market here, market participants are seeing huge divergence in the global commodity market arena, with precious metals finding violent bids on Thursday, both long and short, while soft commodities showed limit up and limit down type trading in a variety of sectors. The fact that coffee, wheat, cotton, soybean and sugar can trade at opposite ends of the buy-sell spectrum, with some going higher at the same time that others go lower, reveals a market that's struggling to find fair value on those soft commodities. The need to create a hedge against US dollar manipulation in global market that trade commodities using the US dollar currency as their base has created an investment-like asset class in commodities rather than leaning towards the commodity market's historical norm that use futures contracts to hedge forward commercial commitments. Commodity markets are used to volatile opens and closes, and very much used to the fact that on some days liquidity will be very thin. Commodities being viewed as more as an investment asset class sets up two things that are likely to happen. Either commodities take on more of the feel of equity trade as mid-term valuations become as important as having to trade the ebbs and flows of global economic demand in commodity markets. Or if that doesn't happen, if commodities don't move to more of an equity-like investment vehicle, global markets are going to move towards the nuances historically seen in commodity trade, which most will not be probably too aware of and probably not too used to. Commodity trade has nuances that embrace thin liquidity at certain times, low volume, and a need to roll over or swap positions at the end of each business day. They are normal nuances for a commodity market. Equity markets are not used to that. And in general, foreign exchange has been leading the way. This could be an inflection point for how all asset classes are going to be viewed. And maybe the commodity nuances will become the norm in equity and interest rate trade. The new generation trader is witnessing a seismic shift towards near-term valuations in all global asset classes, with few market makers willing to hold overnight positions. It would seem that near-term valuations and a willingness to more quickly move from one asset class to another will dominate the first half of 2011 trading. Taking a look at the silver market, we can see both gold and silver along with the hard commodities, including oil as well. All of these have got blue candles and all of them are looking at now an upwards trend. Oil's just hit that base, gave us a new move higher that's pushed oil out of the short trend that it was in the near term and getting it aligned now with the other hard commodities that are moving higher. So these commodities continue the pattern of trade that has 3 or 4 periods of sideways consolidation followed by one session of heavy upside movement. At the current levels, there's no potential signals, either long or short, on any of the main commodity markets, with possibly the exception just of this one, which is oil, which you would get a long signal on from 87 up targeting 88.50. At the current levels, we do need to be very careful about getting into these commodity type periods of trade because this is a consolidation phase that's having very sporadic and then volatile price action movement. And talking of volatile price action movement, taking a look at euro dollar, just about 8 o'clock East Coast time on Friday morning, we had one of the ECB members state that interest rate tightening may have to happen sooner rather than later. And it has to be remembered that in the global market environment we have at this point in time, fundamentals drive direction and technicals will give you the stopping points. So we'd seen on euro dollar a move lower in overnight trade. We'd just broken that long simple moving average trend, but then we had a move that hit the 100-day simple moving average at the same time that the ECB member called for potentially higher interest rates sooner than some may think, and there's the volatile move higher on euro dollar. February has seen a period of trade on the dollar index, which is just an inverted euro chart that's broken the historical inverse correlation between equities and the greenback. History shows a 12-month link that runs around 90% that on any given day would have S&P 500 trade moving in the opposite direction to the dollar index. Although equities have maintained bids at yearly highs, February has been a month of sideways movement in general on stocks, which is being mirrored in dollar index trade. An overlay of the dollar index on the S&P 500 shows all of February being correlated through until the 17th, through until yesterday, where the dollar, having tracked S&P movement virtually bid for bid, on Thursday bucked that trend with violent overnight equity moves that initially tested support on equities and then reversed back higher, which finally forced the dollar index to move in the opposite direction and test support. So from our perspective, we've taken all of February to find a session that then has the dollar moving in the opposite direction of equities. The dollar index remains firmly embedded around the 78 area, with no indication whatsoever that global market participants will allow an easy test of support at 76 on the index, and absolutely no indication that a move lower to 72 could be forthcoming anytime soon. The path of least resistance for the dollar looks to be a continuation of the sideways crawl that has the major global currencies holding ground against the dollar, albeit at a snail's pace that we can see on this euro chart. There is an indication that as soon as S&P 500 equity trade fails to hold support, then market participants will drive the dollar index up through 79, targeting 82 in the near term, which would be a move back down on euro that would get it towards 133. Traders will be very much aware that most foreign exchange moves are coming at the opening of each regional equity market and subsequently then in reaction to red flag economic releases or sound bites, just like we'd seen this morning out of the euro with the soundbite headline that came across that interest rates may have to tighten sooner. The weighting of the dollar index leans heavily towards European currencies, with only 20% of the index value coming outside of the Eurozone. And that's allowed individual currency pairs the ability to test previous sessions' highs or lows, but not easily break and hold, as we can see from this very sporadic, overlaid, choppy Euro chart. They're not good looking charts at this point in time. In review of global trading, it's very clear that the markets are entering a phase that will fundamentally challenge historical norms in regard to price action, daily momentum and expectancy for any position to be held overnight. These changes and evolution is leading to a lot of intraday volatility in the currency markets, as we can see on this chart, with major pairs in a pattern of trade that have few clean breaks from price action ranges that go on to hold without first of all completely reversing. So before you can get that initial breakout to hold, it looks as though you've got to come back and retest the whole breakout area again. And that's what we're seeing in trade on Friday as we close out a very strange period of trade.